Happy Tuesday out there, Team 42. It's your skipper here, Darius Dale, to present our macro minute for Tuesday, December 5th, 2023. So we'll start with our executive summary from our leadoff morning note today. As always, if you want the analysis supporting these conclusions, as well as what to actually do about them in your portfolio, you need to be a client of 42 Macro. So, number one, from our perspective, there are three global economic developments that would help perpetuate the current Goldilocks top down market regime. Number one, Chinese growth is better than feared thanks to the lagged impact of prior stimulus efforts and the pending impact of incremental policy easing. Number two, Europe avoids a hard landing. And number three, the BOJ continues to stave off policy normalization in Japan. Number two, per the 42 Macro Global Liquidity Monitor, China currently has the most favorable policy dynamics abroad. Moreover, China's policy mix is likely to improve in the months ahead as Beijing typically favors front loading stimulus in the calendar year. Wall Street's next 12-month real GDP growth expectations for China are well shy of the 5% target that Beijing is likely to stick with for 2024. Until such dour projections are revised, investors should generally expect positive economic surprises from China over the medium term. And then lastly, number three, regarding the European economy, the November composite PMI readings for the Eurozone, Germany, Italy, and the UK each improved to a multi-month high. Regarding the Japanese economy, the de facto preliminary inflation data for the month of November slowed sharply, reducing pressure upon the BOJ to back away from its still ultra loose monetary policy setting. In addition to the slowdown in inflation, Japan's November composite PMI declined sharply to a contractionary print of 49.6, the lowest level since November of 2022. Transitioning to my 42 macro dashboard this morning. Nice little spot. Just getting started. I see my face up there with our buddy Charles Payne over at Fox Business. That was a great, few short, sweet spot we had yesterday. So definitely check that out when you get time. So in terms of Longbow ranges here, our trading ranges from our friends over at Longbow, we got an oversold signal in the 10-year nominal Treasury yield here. We got also oversold signal on the 10-year tips yield as well. So obviously, if we back up from there, we're going to see a little bit more consolidation in broader equity and credit markets, and obviously in the fixed income market as well. We got a pretty overbought signal here in Bitcoin. Not the upper boundary of the range is obviously continuing to trend higher. So maybe not a hard sell, but it's certainly definitely not the best spot to be chasing a lot of the positive performance we've seen in recent weeks in conjunction with this Goldilocks regime that itself is being perpetuated at the margins by a positive trend in global liquidity. And then lastly, in terms of our 42 macro aware community, we have our store. So we had a question from one of our subscribers asking they be able to look through. They like to be able to look through the historical data for the volatility, just momentum signals for each respective asset. And he's asking, is this info available in the spreadsheet we include in the around the horn every week? And the answer is yes, my friend. So all the data, historical data for all of our models, is included on a weekly basis in our around the horn publication. We include a link to an Excel file that you can download and review the data and the back test for all the signals and portfolio construction guidance that we produce here at 42 Macro. To my knowledge, we are the only firm on Wall Street that publishes all the historical data and back test results for all the models and tools that they put in front of clients. And the reason we do that is obviously because we trust the efficacy of our models. Our models work. They back test very well. They back tested very well on an out of sample basis since the start of our firm, or an out of sample in terms of the construction of the back test. And not to mention, we're really good at what we do. Quite not to mince words at this, but we're one of the few investors that got both 2023 and 2022 right. And we suspect that a lot of investors are going to be very wrong about 2024 in terms of the hyper consensus soft landing expectation that is now priced in the markets. Doesn't mean you need to run out and go put on a hard landing or no landing trade. You need to let this Goldilocks regime play out. But ultimately, we do believe that there is still risk over the medium term that you could go from pricing in a soft landing to pricing in something that looks more like a no landing or hard landing. It could be the case that by the end of 2025, we're still somewhere around the same range in the S&P and the Nasdaq with these violent, factor rotations and violent trades, multi-month trades, kind of chopping us around up and down sideways. That was the history of the 70s in terms of the last inflation episode we saw here in the U.S. economy. Certainly not out here making predictions about that. But one thing we will say is I think the whole act of making predictions as an investor, if you're still someone out there who's, kind of wedded to your prediction generating forecasting process, and then using that process to guide your, the entirety of your portfolio construction and asset allocation. To me, I just think that's just the wrong way to invest. I think you can be a lot better as an investor, and certainly improve your results as an investor by being a lot more systematic about your research process, being a lot more systematic about your risk management process. And that means reacting to the market as opposed to predicting and telling the market what it needs to do according to your predictions. So we'll wrap it up there. Darius Dale presenting our macro minute for Tuesday, December 5th, 2023. Best of luck out there today. We'll catch you back here tomorrow. Cheers.